Welcome to the Deep Dive, your shortcut to being truly well-informed. Today, we're looking at a really interesting situation, FiscalNote Holdings, ticker symbol NOTE. And the core question here is, can this AI-powered intelligence firm, it's trading for less than $1 right now, can it really unlock significant value? Or is it, a classic value trap just teetering on the edge of getting delisted? We're going to unpack the extreme potential here, but also the equally extreme risks, because frankly, this story's ending is, well, it's far from certain. Our analysis today is anchored to July 30, 2025. We've pulled together insights from comprehensive sources to really understand if FiscalNote's intrinsic strengths can, possibly overcome these pretty severe financial challenges it's facing. Get ready for a fascinating high-stakes situation.
It really is quite a picture, isn't it? You've got this stark contrast. Analysts look at it and see potential upsides of like hundreds of percent if they manage a turnaround. But then the market itself, it seems to be pricing in very real risks of significant downside, maybe even, the whole thing going belly up. That huge disconnect is exactly what we need to dig into.
Absolutely. And speaking of real-time insights, just a heads up for those of you following FiscalNote closely, we will be covering their earnings minutes after they're released right here on Stock Analytics AI. So definitely stay tuned for that. And hey, while you're here, don't forget to hit that like button and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. For just $4,099 a month, members get priority deep dives on tickers you choose. Over the next few months, we're actually planning to cover all of the S&P 500 stocks, and members get that exclusive priority access. Want a one-off deep dive just for you? Just drop us a super thanks. Okay, so to help us navigate this complex landscape, we've structured today's deep dive into two main parts. In part one, we'll lay the essential groundwork. We need to understand FiscalNote's core business, take a hard look at its management, and really dissect its financial health. Then in part two, we'll shift our focus. We'll look at market sentiment, the ownership dynamics, who actually holds the power, a comprehensive risk assessment, and then finally, our concluding outlook. All right, let's get started. Let's peel back the layers and really understand what FiscalNote does. We're kicking off with chapter one. Business analysis. Deconstructing the digital intelligence engine. Okay, so at its core, FiscalNote operates on a software as a service model, SaaS. This means the vast majority of their revenue, was a commanding 92% back in 2024, comes from stable, recurring subscriptions. Think of it like predictable income. That's supplemented by some advisory services, a bit of advertising, sponsorships, especially on platforms they own like CQ Roll Call.
Right. And their fundamental promise, their value proposition, is to take what they describe as the overwhelming and unstructured chaos of global policy, legislative, and regulatory data, and basically transform it into clear, actionable intelligence. And the key here is they do this using their own proprietary artificial intelligence platform. So it's about making data smart, really.
So, okay, what does this mean for you, the listener, in practice? Well, imagine you're a government relations professional. FiscalNote could give you AI-powered alerts on, say, crucial bill amendments right when they happen. Or maybe you're with a nonprofit. They have a tool called Voter Voice that helps you launch targeted advocacy campaigns, with real precision.
Exactly. They're not just slinging data. They offer the workflow tools and, importantly, the expert analysis that helps turn that raw information into, well, a competitive edge for their clients.
And their product ecosystem, it's quite comprehensive. The heart of it seems to be this policy and issues management suite with the flagship product called FiscalNote. That's their AI-powered platform for tracking legislation, regulations, all that stuff. And it's really enhanced by assets they acquired, like CQ Federal and Roll Call. Those bring nonpartisan news on the U.S. Congress, and crucially, a lot of built-in trust.
Beyond that, they've got Voter Voice for digital advocacy, like you mentioned. They also expanded into global and market intelligence through acquisitions like Frontier View and Oxford Analytica. Though it's important to note some of these have actually been divested recently as part of their new strategy.
Yeah.
And for constituent services, for congressional offices, they offer a tool called Fireside.
No, size-wise, FiscalNote is what we call a microcap company. Its market capitalization as of our analysis date was hovering around, what, $123.25 million.
Yeah, and that microcap label is really key here, especially when you look at the extreme volatility. Its market cap is actually up over 19% since it went public via that SPAC deal, the special purpose acquisition company route, faster than an IPO, often. But, and this is a big but, it's also plummeted over 50% in just the last year. It's like a tiny boat in an ocean with these multi-billion-dollar giants like Thomson Reuters and Bloomberg swimming around.
And the industry they're in, this regulatory intelligence space, it's genuinely booming. I mean, think about it, the increasing complexity globally. New rules for AI, ESG reporting, data privacy, trying to track all that manually, it's just inefficient now. So the market's really moving towards AI and machine learning tools for predictive insights. This directly validates FiscalNote's whole model, really.
Definitely validates the need. However, the competitive landscape, as you alluded to, it's formidable. You've got the incumbents, Bloomberg Government, LexisNexis, Thomson Reuters, huge resources there. But there are also lots of specialized niche players focusing on specific areas. FiscalNote's trying to compete on, well, technological superiority and integrating everything together, aiming for that unified AI-powered platform.
And getting into this space isn't easy. The barriers to entry are pretty substantial. You've got immense technological complexity. The data itself is complex. Then there's the need for brand trust. That's where acquiring CQ and Roll Call was so smart. And finally, high switching costs. Once clients embed these tools into their daily workflows, moving away is a real headache.
Yeah, that CQ Roll Call acquisition, looking back, it really was a masterstroke for brand building. It instantly gave FiscalNote decades of accumulated trust, journalistic integrity right there in Washington, D.C. That creates a competitive moat, a barrier that's really difficult for others to just replicate quickly.
Plus, as a SaaS provider, they have those consistently high gross profit margins. We're talking 78–82% range typically. What this means for you is that the cost of adding one more user once the platform's built is very low. That's the beauty of SaaS. And their AI platform, theoretically, promises economies of scale in processing all that data.
And customers tend to stick around. They benefit from, let's say, moderately high switching costs because clients integrate FiscalNote's tools so deeply into how they work, tracking policy, managing advocacy campaigns, migrating all that to a new system. It's disruptive, it's risky. That fosters stickiness, keeps customers locked in.
So their most significant unique asset has got to be that integrated AI-powered tech platform. It's protected by, 41 patents, and it's designed to synthesize data from all their different products, connecting the dots across policy domains. That's potentially a really powerful differentiator. Okay, but here's where it gets really interesting. There's a kind of paradox at FiscalNote's strategic heart. On one hand, it presents itself like this high-growth, AI-powered SaaS firm, scalable tech, those great gross margins. But on the other hand, it also owns CQ Roll Call, which is, let's be honest, a legacy media and publishing house. And a SaaS business scales very differently from a traditional newsroom with high fixed costs, journalists, etc. Now, the acquisition definitely brought credibility, no doubt. But could these legacy assets actually be acting as a financial anchor, maybe masking the true profitability or lack thereof of the core SaaS business? The pivotal question really for the future is, can management prove that the valuable CQ content directly enhances the AI in a way that drives scalable SaaS revenue? Or is it just, kind of dragging things down financially?
And if you connect that to the bigger picture, the very market driver fueling FiscalNote's growth, this increasing global regulatory complexity that also represents a huge operational challenge for them. It creates what some call a Red Queen's race, like in Alice in Wonderland, where you have to run faster and faster just to stay in the same place. They have to continuously invest more in R&D and data acquisition just to keep their product relevant and high quality. The key is whether their AI can automate this process more efficiently, more cost-effectively than their competitors can.
Okay, fascinating dynamics in the business itself. Now let's shift focus to the people at the helm. We're moving into Chapter 2, Management Evaluation, Stewards of Capital or Architects of Debt. So the leadership team, it's spearheaded by an EO and President Josh Resnick. He's got 25-plus years of experience, including leading a prior company to a successful acquisition. And importantly, he's held key operational roles within FiscalNote itself, so he should know the company inside out.
Yeah, and the current management team, well, they seem to be operating very much in crisis response mode right now. You can see a clear turnaround strategy emerging. They're divesting non-core assets, we mentioned some of those earlier, specifically to pay down debt. And maybe most significantly, they were pursuing that potential reverse stock split to try and regain NYSE compliance.
Right, the reverse split. And while they were transparent about announcing it, The market reaction was just brutal, a 23.5% stock plunge on the news. It really suggests a deep credibility gap, doesn't it? Because even if you're transparently delivering bad news, it can still shatter investor confidence, especially when it seems to confirm the bear's worst fears.
It absolutely can. And looking back historically, FiscalNote pursued this incredibly aggressive M&A strategy, 15 acquisitions since 2017, I think. That builds scale, sure, but it was heavily debt-fueled, and that's led directly to the high-leverage situation they're in now.
Which makes the current strategy such a dramatic U-turn, a complete 180. Now it's systematic divestiture. Timebase, ISIL Technologies, Board.org, Oxford Analytica, Dragonfly.
They're selling off these pieces. The stated purpose seems clear. Unlock value, simplify the business, reduce complexity, and crucially, use the proceeds to pay down that debt and reinvest in the core AI platform.
It feels like a necessary reaction, really, to those past excesses. That prior debt-fueled growth just wasn't sustainable. And frankly, it was destructive to shareholder value. You see that clearly in their deeply negative return on invested capital, the ROIC.
Yeah, let's talk about that ROIC. What does a deeply negative ROIC cited between, -8% and -13% actually mean for you, the listener? It basically means that for every dollar FiscalNote has invested in its business through acquisitions, R&D, whatever, it's actually been destroying value, not creating it. The returns are less than the cost of the capital used. That's far, far lower than their estimated cost of capital to WACC, which is estimated around 11%. So they're earning much less than it costs them to fund their investments. That's a fundamental problem.
It really is. And this raises an important point about how they present their financials. The narrative is often dominated by what you might call the adjusted EBITDA mirage. Management highlights positive adjusted EBITDA, I think, for 6 consecutive quarters now, which sounds good on the surface. But remember, adjusted EBITDA is a non-GAAP metric. It's not standardized. Companies can add back all sorts of expenses. So for instance, in 2024, they reported positive adjusted EBITDA of $9.8 million. Okay, but their free cash flow, the actual cash generated or burned by the business, was negative $14.18 million. And why the difference? Well, significant add-backs, things like amortization of intangibles from past acquisitions or substantial stock-based compensation. And stock-based comp, while non-cash, is a real expense to shareholders through dilution. It makes your slice of the pie smaller. So this adjusted EBITDA figure can really obscure the true economic reality of cash leaving the building.
Right. It's like calculating your personal budget but deciding not to count your rent payment because it's, adjusted. Doesn't reflect reality. And here's where the plot, well, it thickens even more. We talked about insider ownership being high, around 37%. That sounds good, aligns interests, right? But then you look at the actual insider transactions, and you see this consistent pattern of selling by key executives. The CEO, Josh Resnick, himself, 36 sales, 0 open market buys over 5 years, the complete absence of any voluntary open market purchases by the people who know the company best during a time when the stock prices collapsed. That's an incredibly powerful negative signal, isn't it?
It's a huge red flag.
Yeah.
It creates a substantial credibility problem for you as a potential investor. If management truly believed the stock was deeply undervalued, wouldn't common sense suggest they'd be buying shares hand over fist? The lack of buying speaks volumes.
Okay, we've looked at the business model, the strategy, the management actions. Let's get down to the brass tacks, the numbers. What story do FiscalNote's financials tell us? We're diving into Chapter 3, Financial Analysis. A story of high margins and deep losses. We've already touched on its microcap status, that extreme volatility in market cap. It's been a roller coaster for shareholders.
And on the revenue side, remember, it grew aggressively, fueled by M&A, from about $65 million in 2020 to a peak near $133 million in 2023. But then it reversed course in 2024 down to $120 million. And it's projected to decline further in 2025, maybe to $94 million, specifically because of these planned divestitures. So it's really crucial for you to understand this is a strategic contraction. They're shrinking to focus, hopefully, not just collapsing.
Yeah, the profit margins really highlight that paradox we mentioned earlier. You've got this exceptionally strong gross margin, 78% TTM, trailing 12 months. Very healthy for a SaaS business. But then you look further down the income statement, operating margin, deeply negative, around minus 30% TTM. Net margin, even worse, profoundly negative, minus 39% TTM. So basically, high operating costs, things like sales and marketing, R&D, and then those significant interest payments on the debt, they're just completely wiping out that impressive gross profit.
And the free cash flow picture, well, it's been consistently and often increasingly negative. That is a major, major red flag for any company, especially one trying to grow. Now, it did improve from burning almost $84 million in 2022 to burning about $14 million TTM. So better, but still burning cash.
Management keeps saying they aim for positive free cash flow, but they're clearly not there yet. For you, this means FiscalNote is still spending more cash than it brings in just to run its day-to-day operations and invest. That's not sustainable long-term without more financing or asset sales.
And this isn't a new problem, is it? The company has this consistent history of unprofitability. They've never achieved a full year of GAAP profitability that's using standard accounting rules. Diluted earnings per share, EPS, consistently negative over the last 5 years.
Exactly. And the balance sheet reflects that strain. It shows high financial leverage. The debt-to-equity ratio is around 1.45. That creates substantial risk, mainly because those interest payments drain precious cash. Now, it has improved. It was over 11,198% at its peak, which is just astronomical. So 1.45 is better, but it's still quite elevated for a company that isn't actually generating cash flow from its operations.
What about short-term health? Their short-term liquidity, indicated by the current ratio, seems okay on paper, between 1.12 and 1.28. That suggests they have slightly more current assets than current liabilities. It gives them some breathing room, yes, but it's definitely what you'd call a tight cushion. They don't have a huge margin for error.
Yeah, very tight. Now, when it comes to valuation, trying to value this company is tricky. A price to earnings, or PE ratio. Meaningless because earnings are negative, but the price to sales, or PS ratio, is around 1.06. And typically, for a SaaS company, that would be considered quite inexpensive. However, and this is critical for you to grasp, that low multiple directly reflects the market's perception of all these significant financial risks we've been laying out. It's cheap for a reason, essentially.
So, trying to calculate an intrinsic value using a discounted cash flow or DCF analysis, that's exceptionally challenging here, isn't it? With negative free cash flow, the model becomes incredibly sensitive to your assumptions about the future.
It's extremely sensitive. Garbage in, garbage out, potentially. But we can run an educational DCF model just to illustrate the sheer range of possibilities here. And it shows a very, very wide range. In a bear case, if they fail to turn things around, fail to achieve sustained positive free cash flow, the intrinsic value could approach zero, total loss potential. In a base case, maybe they execute the turnaround reasonably well. If management successfully hits positive free cash flow in the next, say, 2-3 years, you could maybe justify a value of $1.50 to $2 per share, still way above current prices. And then there's the bull case. If the turnaround is rapid, if it exceeds expectations, if they start generating significant cash flow faster, perhaps you could argue for $2.50 to $2.50 per share, maybe even higher.
Wow, so $0 to potentially $3.50 plus center. That's a huge range, really highlighting the risk. What are the key assumptions you'd need to believe for even the base or bull case DCF to hold water?
Right, the key assumptions are critical. You'd need to basically trust management's 2025 revenue guidance. Even with divestitures, you'd need to see a reacceleration of organic growth after they shed those assets. You'd need free cash flow margins to actually turn positive in, say, fiscal 2026 or 2027, and then expand significantly, maybe to 15-20% longer term, which is typical for mature SaaS. And finally, because of all the risk, you'd have to use a pretty high discount rate in your DCF model, maybe 12%, 15%, even higher to properly account for that extreme uncertainty.
Makes sense. Very high hurdles to clear for that valuation gap to close. Okay, let's move into part 2 of our deep dive now. We're going to look at the broader context, starting with chapter 4, market sentiment. The tug of war between analysts and short sellers. And it really is a tug of war, isn't it? On one side, you've got Wall Street analysts. Their consensus rating is actually strong buy. Average 12-month price targets range from $2.63 all the way up to $3.79. That implies potential upside from the current price of, 230% to over 370%. That's a massive disconnect for you to consider.
A huge disconnect. Yet, look at how the market actually reacts to news. That announcement about the potential reverse stock split on July 29th, aimed at regaining NYSE compliance. The stock plunged 23.5%. The market clearly didn't see it as a positive step towards stability. It interpreted it as, well, a sign of desperation, completely overshadowing any analyst optimism or potential operational positives.
Yeah, it felt like that announcement just acted as this powerful confirmation for everyone betting against the company. It validated the entire bearish thesis, and you saw that reflected in the high short interest.
Exactly. And that short interest is exceptionally high. Right. Around 16.70% of the publicly traded float is sold short. The days to cover ratio is over 4. For you, that means, assuming typical trading volume, it would take short sellers more than 4 full trading days just to buy back all the shares they've borrowed and sold short. That indicates deep conviction among the bears. They're dug in.
And technically, the picture reinforces that bearishness. The stock's trading well below its 50-day moving average, which is around $1.64, and significantly below its 200-day moving average, near $1.93. just confirms the strong downtrend.
So you have this clear battleground. Analysts, extremely bullish, high targets. The market, judged by short interest and technicals, deeply pessimistic. It really raises the question, doesn't it? Who is going to be proven right here?
A key question indeed. So if the market's locked in this tug of war, who are the main players holding the ropes? Let's move on to Chapter 5. Ownership structure. Who holds the reins? Looking at institutional ownership, it seems moderate. There's some variance in the data, but you see big names like BlackRock and Vanguard, mostly through index funds. More notably, perhaps, a top shareholder is Mezzo Capital Partners Ltd. That's a hedge fund, and they often take an activist stance in these kinds of distressed situations, so they could potentially push for changes.
That's one to watch. Then you have insider ownership, which we know is exceptionally high, nearly 37%. On the surface, yeah, that should align interests. Management owns a big chunk, they should want the stock up. However, as we keep coming back to, that consistent pattern of insider selling, combined with the complete absence of any open market purchases by key executives, well, it's a powerful negative signal that you, the potential investor, simply can't ignore. It undermines that alignment argument.
And ownership is also highly concentrated, isn't it? A small group of stakeholders holds over 67% of the total voting power. That concentration is likely why we saw swift decisions, like the board authorizing that reverse stock split, happen relatively easily. They have the votes.
Precisely. And that concentration, it's a real double-edged sword. On one hand, it allows for decisive action during a crisis, which might be necessary. But on the other hand, it effectively disenfranchises minority shareholders. Your vote doesn't really count for much. Your investment here becomes less about the pure fundamentals and more of a bet on the judgment, the integrity, and the execution ability of this specific controlling group. And that, again, makes the glaring lack of insider buying an even more potent and, frankly, worrying signal for you to consider.
Okay, definitely adds another layer of complexity and risk. Let's try and consolidate all these potential pitfalls and weigh them against the positives. Time for Chapter 6, Risk Assessment, Navigating the Headwinds. Let's quickly run through a SWOT analysis: strengths, weaknesses, opportunities, threats. For strengths, we've got that proprietary AI-driven platform, those 41 patents backing it up, established, trusted brands like CQ Roll Call, those high gross margins indicating sauce potential, and at least theoretically, high insider ownership aligning interests. But the weaknesses are severe. A crushing debt burden, a consistent history of unprofitability and burning cash, past capital allocation that actually destroyed value, remember that negative ROIC, and a heavy dependence on an as yet unproven turnaround strategy. What about opportunities? Well, the industry itself is growing strongly thanks to that increasing global regulatory complexity. There's significant potential for FiscalNote to use its AI for expansion and cross-selling to its existing client base. There's also the possibility of a successful strategic refocusing. Maybe they do create a leaner, more profitable company. And of course, ongoing product innovation could keep them competitive. But then the threats. The most immediate, most stark is that NYSE delisting threat. They have until October 10, 2025 to get that share price back up. Otherwise, they risk being kicked off the exchange. Beyond that, intense competition from those well-capitalized giants, high execution risk, can they actually pull off this turnaround? Liquidity risk, will they have enough cash? And the permanent market stigma that often comes with a reverse stock split, even if necessary.
And if we connect this to the bigger economic picture, factors like high interest rates are particularly dangerous for a company like FiscalNote with so much debt. Higher rates directly increase their interest expenses, draining even more cash. And it makes refinancing that debt down the road much harder and more expensive.
Yeah, and here's an interesting, maybe more subtle threat that you might overlook. The U.S. tariffs of 2025. Now, FiscalNote isn't selling physical goods affected directly, but increased costs for their clients due to tariffs can lead to what you might call client budget contagion. What does that mean for you? It means FiscalNote's clients start scrutinizing all their expenses more intensely, including software purchases. That could lead to longer sales cycles for FiscalNote, more pressure on their pricing, maybe higher customer churn, directly threatening their revenue projections. It's an indirect ripple effect from those tariffs.
That's a really good point. And it brings us back to that October 10th delisting deadline. It acts as this powerful financial forcing function. It drastically compresses management's timeline. It forces them to prioritize solving the immediate, almost cosmetic problem of the stock price, just getting it above $1, perhaps at the expense of focusing on the long-term fundamental problem of achieving sustainable profitability and positive cash flow. There's a real risk it diverts critical attention and resources away from the core business needs, like product innovation and sales execution, which are ultimately what will drive long-term value.
A very tricky balancing act for management. Okay, we've covered a lot of ground. Let's try and bring it all together now in our Chapter 7. Conclusion.
Okay, so the bull case for FiscalNote. It's definitely a high-risk, high-reward turnaround play. It really hinges on the belief that the market has just excessively punished the company. Bulls would argue the market is overlooking the valuable core AI platform, those strong brands like CQ Roll Call, the attractive high-margin SaaS model underneath it all, and what looks like a credible turnaround plan that is showing some early signs of progress debt reduction, that positive adjusted EBITDA figure, even with its caveats. And it's a big if that plan succeeds, then yes, the company appears profoundly undervalued at its current share price.
But the bear case paints a very different picture. Bears argue FiscalNote is a classic value trap. It looks cheap, but it's cheap for very good reasons. It's burdened by that crushing debt load. It has a long, consistent history of gap losses and burning through cash. Its past capital allocation decisions were demonstrably value destructive. And that focus on adjusted EBITDA, bears see that largely as a distraction, something that masks the ongoing cash burn and fundamental financial weaknesses.
Plus, the company faces genuinely existential threats. That NYSE delisting risk is real. Competition is intense. There's a severe market stigma now attached to the stock. And fundamentally, that consistent pattern of insider selling with zero open market buying from key executives, it just fundamentally undermines confidence in management's whole turnaround narrative. Why should outside investors believe it if the insiders aren't putting their own money behind it?
So wrapping it all up, what does this mean for you, the listener, considering this stock? Our intrinsic valuation, using that educational DCF model, it yielded that incredibly wide range of potential values, from potentially approaching zero in a bear scenario, all the way up to maybe $2, $3.50, perhaps even more in a really bullish scenario. That vast gap just underscores the truly binary high-risk nature of this investment proposition. It could go spectacularly right or spectacularly wrong.
FiscalNote Holdings really represents this stark dichotomy, doesn't it? It seems to possess the DNA, the building blocks of a valuable modern technology company, the AI, the SaaS model, the data assets. Yet, at the same time, it is severely, maybe critically burdened by the financial consequences of its past debt-fueled growth strategy.
Yeah. The current share price clearly reflects deep pessimism. The market seems to be pricing in a high probability of continued struggle or maybe even outright failure. Investing in Note today, therefore, isn't really a bet on its current state. It's a highly speculative wager. It's a bet that management can somehow navigate these immediate crises, the debt, the delisting threat, and successfully transform the company's operational potential into tangible, sustainable, free cash flow. The chasm between that potential intrinsic value and the current market price is indeed vast. But the risks, the hurdles preventing that gap from closing, seem equally substantial. So here's a final thought for you, the learner, to ponder. How do you weigh the words of management, their publicly stated turnaround goals, their presentations, against the actual actions of insiders who are consistently selling their shares, especially when a company is facing such critical make-or-break deadlines? It's a powerful question and one worth considering for any high-stakes investment. And that wraps up our deep dive into FiscalNote Holdings, Inc., ticker note. Remember to like this video and subscribe to the Stock Analytics AI YouTube channel to get more deep dives like this one. Members get priority on deep dives covering all the S&P 500 stocks over the coming months. And if you have a specific ticker you want us to cover in a one-off deep dive, just drop us a simple thanks.
And just a reminder, this analysis was generated by an AI system purely for educational purposes. It should absolutely not be considered financial advice. Please always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.